Welcome back to Fast Money. The countdown is on. The presidential election is now just 1 week away, and Fast Money is trading the vote. Our next guest says he has the ultimate hedge if rates rocket higher post-election. Let's go off the charts with Chris Verrone of Strategas. Chris, what are you looking at?
So I'm looking at rates here to start, and I think if there's going to be a source of volatility over the next couple of weeks, it probably comes from rates up, not rates down. Rates down has been the status quo for years. I think rates up would be the source of any vol here. So I want to look at a couple charts, and I want to talk about some ways to play this. These are 10-year yields, short term, really just over the last 3 or 4 months. This uptrend that began in late August, early September is actually still intact here. I know rates down a little bit over the last several days, but that trend line has not been violated. We think you find good support in 10-year yields somewhere in this 73, 74, 75 basis point range. I think that will propel rates higher from here. What's been important for us, if you look at the last several days, even as equity markets have come under pressure, even as concerns about virus, election, and stimulus have come to the forefront, credit spreads have actually not deteriorated to any meaningful extent. I want to show you double B corporate spreads. So high yield spreads here continue to trade near their cycle lows, their recovery lows. So I think the message from credit here says, even with rates up, the economic backdrop or the economic recovery is probably in shape. And what group or what sectors can we think about maybe adding some exposure to in that environment? I would point you to the regional banks here. And I want to start by showing you the Regional Bank ETF. That's the KRE. Very quietly, it's crept back above its 200-day moving average. There's some good support here near 39. But what's most important for us is relative to the S&P, regional banks have actually quietly started to outperform. They made new 3-month relative highs versus the S&P this week. And if you look at the regionals versus the money centers, they've actually really started to outperform. Regionals have underperformed the money centers for the last couple of years. That seems to be changing over the last several months here. 2 names in particular that stand out. Fifth Third on the long side, ticker FITB, quietly back above its 200-day moving average. The 50 is above the 200 there as well. And then Silicon Valley Bank, ticker SIVB. This is probably the best looking of the regional bank charts. It's broken out of a big base. It's improved relative to the S&P. So I think with bond yields, we think ultimately higher here. Credit spreads contained. Look to some of these regional banks for opportunities as an election hedge.
So, Chris, if the assumption is that rates are going to go higher and this is an election hedge, is the assumption that Biden will win?
I think the assumption here is there's a week to go and the race isn't over, and I want to be prepared for different outcomes. I think importantly, when you look at some of the setups here, rates have been quietly grinding higher over the last 2 or 3 months without much attention. I think that's more of a commentary on the economy. We think the market here, the bond market's telling us that the economic recovery is still in pretty good shape, irrespective of who wins 1 week from tonight. All
right, Chris, great to see you. Thank you.
Thank you.
Chris Verrone of Strategas. Guy, you like any of Chris's charts?
It's interesting. The KREs, and Chris can speak to this, and I know you could buy them, so I'm not asking him, but it's the inverse of the TLT. And I mention that because on the beginning of June, I think it was June 8th, the TLT bottomed out around 155. The same day the KRE topped out at 46. So if you think yields are going higher, in other words, the TLT is going to go back and test that 156 level, then the KRE is the place to be. In terms of the big banks, and we've talked about this for a while, and we have to bring it up because it's such an unmitigated disaster, and that's the word we use now for a long time. I mean, Wells Fargo trades like it's gone. You're talking about a multi-year low through that March low of $22. It's trying to tell you something, probably Wells Fargo specific. But then you throw in some other banks, Citi, for example, and maybe that's telling a bit of a different story. But KRE specifically, again, if you think rates are going higher, KRE to $46.
And obviously, Citi and Wells Fargo both have regulatory issues, regulatory overhang in their stories. But Grasso, it's interesting to think about these banks, and specifically regional banks, as an election hedge, because when talking about rates and bonds in the election, the assumption is always that a Democratic win would lead to a lot more spending, would lead to a lot more bond issuance, and you would see rates go higher then. But here we are saying this is a hedge for the election, regardless of the outcome.
Yeah, I'm with you. I'm a big fan of Chris's work, but I'm with you. First of all, you need the 10-year. If you overlay the 10-year on whether it's the KRE or XLF, they're in lockstep. So I do like his Silicon Valley Bank pick. That's up 15% year to date. That's an anomaly with banks, whether it's regionals or the money center banks. But to your question, if Biden wins the election, rates will go higher, banks will work. But I do think, as of late, there's a lot of different polls that are on the inside that you're not hearing about. And I do think the biggest upset will be like a 2016 if Trump wins a re-election bid. And then what I think you're going to see is people piling back into tech and selling all of these cyclical plays, and rates do not explode higher. So it depends on what you call an election year hedge, but the Biden would be your pick if you want banks to run.
Shepard Smith here. Thanks for watching CNBC on YouTube.